Time to take your wealth to the next level. Welcome to Learn Wealthy, your go-to channel for real estate insights, market charts, and golden opportunity. Let's build wealth together.
This video is not a financial advice. We are not attorneys, CPAs, or financial advisors. This video is made for entertainment purposes only, so do not take them as financial advice. We do not know your personal specific financial situation. We suggest you seek an actual financial advisor for real financial advice. Thank you.
What's up, guys? This is James Santiago, and welcome to another episode of Learn Wealthy. So today we're going to talk about how home prices. When is it a good time to buy a house? Is it a good time to buy a house now? Will there come a time in the near future that it's going to be a good time to buy a house? So we'll go over charts and data to actually have a clearer picture of what's going to happen and when's the best time to buy a house. The reason I wanted to make a YouTube video on this today, because I've been seeing agents online putting the FOMO in people. FOMO means fear of missing out. So they're saying, contact me right now so you can buy a house. The last crash in 2020, they cut down the interest rates, and most likely when they cut down the interest rates, everybody's going to start buying like crazy and prices are going to go up. So hit me up now so we can start getting you a house right now. So, yeah. Let us go over that and see if there's any truth to that. We're going to go over charts. We're going to go over data and to see where real estate is right now, really, and if it's good for you to buy a house. So let's start over with the Case-Shiller Index. The Case-Shiller. This is the Case-Shiller home pricing. They basically average home prices in the U.S. This chart is founded by Dr. Robert Shiller, and this is from the Federal Reserve's website. This is adjusted for inflation. Okay, so it's very important that we adjust things for inflation. And in a sense, CPI. This is adjusted for CPI, Consumer Price Index, or Consumer Price Inflation. It's right here. All right. So in a sense, CPI is a derivative of income, right? Because, yeah, basically income and CPI follow each other, basically. Because if CPI, if prices are getting too much and people can't afford it, right, then there's going to be a disinflation or deflation to match people's incomes where they can afford it. Or income will go up and meet the price of goods, It's a derivative of each other. They kind of play with each other, So we have to adjust things for inflation. So this is national average home prices, adjust for inflation. As you can see, this is the 2007, 2008 bubble right here before the crash. And where are we now? 2004 May right here. This is the most updated. It always like makes me cringe that with all the staff and PhD economists in the Federal Reserve using our tax money, that they can't update their charts to current. This is May 2024, but this is where we are now, basically since 2022. The national home prices adjusted for inflation, adjusted for CPI, higher than where we at in 2007. Would you say this is a bubble? Right? Yeah, but we're always in a bubble though. Like even here in this part is a bubble. The question is, are you in the beginning stage of a bubble, or are you in a stage where it's almost gonna pop and boop and go down, right? So I would say the trend line. There's a trend line going this way, right? Follow the arrow of the mouse. There's a trend line. There's a trend going this way. Yep. And I say that trend line right here where the arrow is, the black arrow, like going that way, I say that is where the trend line, that is where the home prices will come back down, right here to that trend line. So that trend line we're here. So I say when it comes back down, and as you noticed, you see the stock market, I believe it was a Dow Jones index, went crashing down by over 1,000 like the other day after the like a day or two after the Psalms rule got triggered, right? You see Dow Jones just crashed like that. A lot of stocks just crashed down like that. But see what happens to housing. See how it just grinds down. You got 2008 crash right here. It's really December. It's really December 2007 crash. But usually NBER is the entity that announces recession. They're usually super late. They announce the recession usually 1 year after the recession happens. So they don't announce that we're going to have a recession. They always announce that we've had a recession, right? And meanwhile, while they forgot to announce last year that there was a recession, there's all these media and CNN and all the mainstream saying, oh, the economy is booming, economy is great, while we were in the recession at that time. And it's always that same narrative, all right? It's crazy. So as you can see, my point, the Dow Jones just crashed. Bitcoin just crashed. But real estate doesn't do that. It just kind of grinds down slowly over time. You know, see this. This is 2007 when it hit its peak, right? And it just grinded down slowly. And it didn't hit rock bottom till February of 2012. That's how slow prices go down. That's how slow prices come down in real estate. It doesn't just drop, right? It just grinds down slowly. Like markets, like because a transaction in real estate takes like a month and a half to 3 months, you know, to do. You have to start finding a house, or when you're a lister of your house, you have to like list your house, find an agent, and you know and then list the house on the market for a few months, you know, until you find a buyer. And then when you have a buyer, you'll probably be in escrow for 30 days if there's no issues. More if there's issues, you know. So it takes a long time to process the purchasing of a house and selling of a house. So I think that does a lot with the way that the real estate moves slowly when it comes to like the business cycle of the ups and downs. That it doesn't really drop or crash. It just grinds down slowly, and people are just like wondering, oh, this price is like went down by a lot, and people are gonna be in denial. My house is not that. My house won't be sold for that low, and people are gonna be in denial until they realize there's no demand, there's no jobs, people don't have money, there's no liquidity in the market, and until they're gonna have to accept, maybe sometimes by force, because they lost their job, you know, and even if their house is paid off. And if you can't pay your property taxes, your HOA, you can still lose your house, right? So that's what happened. That's what happened. That's the peak of 2008, adjusted for inflation. So pretty much considering income, people's income, and I believe that's where the trend is. You know, you got like asset prices going up, whether stocks, real estate. At the end of the day, it's always got to go back down to income, right? It always got to go back down to income. What people can buy, because people use income. It makes sense. People use income to buy these asset prices, right? So in short, that asset prices can't leave income too much. It's either income has to go up and meet it, or it has to. And I don't think income is gonna go up in a time of AI, like where we're gonna lose a lot of jobs, in a time that of increased inflation, where companies' margins are getting thinner. Because remember, inflation is bad for companies, right? Because their cost to produce their goods and to hire people is a lot, and their margins, their profit margins are getting slim. So, and these are the times where, right now, it's a good example where companies are really slashing employees, and I don't think we're actually in a like we're probably at least at the beginning of a recession, but I don't think we're really like deep in the recession yet. As you know, if you watch this channel regularly, we always talk about the yield curve, one of the most accurate 10-2-year Treasury spread. And to me, to a lot of really good economists, That is the pretty much the number one indicator of incoming recession, and where we are right now. So an inversion. This is the inversion, right? This is the inversion of the 10-year and 2-year when it goes down the black line. And when it uninverts, when it goes back above the black line, you get the recession. The recession is this gray bar right here, right? And it always happens through history, even if you go way back. This is as far as the Federal Reserve chart will take me. But, see, you always get inversion, uninversion, and recession. That's 2008. And so we are in a massive, that's a big inversion right now, signaling most likely a massive recession. And we just had I believe we had an unfinished recession here in 2020. You see how short it is as a little recession? Because they put out PPP loans. They prevented people from actually getting foreclosed with all the moratorium, and prevented people from getting evicted, and they increased a lot of people's income. They showered money to people, basically. If you look at the Federal Reserve's chart, income, wages, adjusted for inflation. If you look at that 2020, look at what happened to income, right? This is income adjusted for inflation. It just spiked. Boom. Look at that spike right here from Q1. You're at 367, and Q3 by Q2, second quarter, you have a 393. That's a big jump right there, right? So they showered a lot of people money. They gave. I'm a registered nurse, as you know. They gave all these bonuses in the hospital, so people's income spiked, and which is part of the reason why real estate didn't tank at that time, because people had money to buy these houses and take advantage of the 2% mortgages. But so when everybody's so certain, like you buy a house right now because because market's not gonna tank. I'm not into that. We're just playing probabilities here. We're just playing probabilities. We don't know that the government is gonna print about $8 trillion again and shower money to people when they cut rates. But cutting rates is not the reason why you should buy a house, basically. Cutting rates is a sign that something is not good in the economy, in the Eurodollar system, right? If economy is running on all 8 cylinders, then why cut rates, right? Cutting rates is usually a bad sign. People are thinking, the Fed's gonna cut rates, so we're gonna have a lot of money. That's not true. Cutting rates is what they do to mediate the problem, the contagion that's already in the system. And the PPP loans and showering money to everybody and stimmies, that's a whole different story that kind of prevented that 2020 crash to happen. But it's not always the case. I don't think, some say Fed already beat inflation at 3%. Their goal is 2%, which they kind of just pulled out of their behind. Why should inflation be at 2%? Oh, let's just put out in the media that a good inflation is 2%. That doesn't make sense, right? Why not no inflation, right? So they haven't even beaten that 2% that they and I would argue that part of all the 9% inflation that we've had, like 2021, 2022, is part of all that PPP loans and stimmies, because money is produced through debt, right? So would you argue that the government is gonna do that again and shower? Yes, I agree they're gonna cut rates, not because a Federal Reserve is gonna cut rates, not because they want to, but they have to because of because it's going crazy in the system with the lack of liquidity, and so they're gonna cut rates because new money is not getting produced if banks are crashing here and there, and there's a credit crisis. So yeah, I'm not counting on cutting rates as the reason for people to be encouraged to buy a house and yep. Cutting rates is not the reason why people should be able to buy a house, and it's not saying that economy is good. It's saying economy is bad if Fed had to cut rates. All right. So, well, you know, everything is you know, you can't just say, oh, you can't just buy a house, but you got to compare it. What's the other alternative, right? So the other alternative is renting. So it's saying here on the bank rate that average monthly mortgage is $2,703, and the average monthly rent is $1,979. So it's definitely a lot cheaper to rent. And this is like for the same house, I would say, for the same kind of house. It also says here in this. This is a website by visualcapitalist.com. It's saying that the average here, visualcapitalist.com. It's saying that average cost to monthly cost to own a house is about $2,700 and about $1,800 to rent. So you have to take into consideration that your option is this: $1,800, let's say $1,900 a month. Your option is $1,900 a month versus $2,700 a month, right? Oh, but you gotta say, oh, well, at least if you actually own the house, that you that part of what you're paying, that $2,700, is going to your equity. Wrong. If you've seen an amortization table, let's say on that $2,700, well, a big chunk of it is going to go in your property tax and your insurance, and you're never going to see that money again. And then whatever's left is going to be between your principal and interest. And during the first 7 to 10 years, most of it, about $200, is probably going to get paid in your principal. $200, $300 maybe. You know, but most of it is going to be paid in your interest rate. And as time goes by, then that's the only time where you start seeing major principal payments, about 7 to 10 years. So you can't argue that in the first 7 to 10 years. So maybe if you're going to own the house for 15 years, then maybe it makes sense, right? But you're going to say, like, so you're saving like probably $800, $700, $800 here just by renting, not considering the down payment that you put in to get that monthly mortgage, and all the repairs, because you don't have to fix the water heater or roof if you're a tenant, right? Not considering all that, right? You're probably saving $700, $800 as just renting. So I'm never gonna give you the FOMO. You're not missing out anything by renting right now, right? Rent. The alternative is definitely so much cheaper, and also you might think like, well, the prices of the house gonna go up. Not all the time. Really, the 10-year and 2-year Treasury saying we're headed for a recession, and you're leaning on, again, nothing's certain, right? Everything is just a probability. That's how investors do it. That's how people should play the game, right? You can't be too sure. That's why you have to keep educating yourself and finding more data to support your theses, right? So really, an incoming recession, saying by the most accurate indicator in history, the yield curve, right? The yield curve is saying we have a massive inversion, therefore possibly a massive recession, and you're gonna lean that houses are just gonna go up and up and up in value forever, indefinitely, without it coming back to the wages, to a reality, what people can afford, right? So yeah, and also your equity doesn't really go up with the inflation, right? Your equity doesn't go up with inflation. Your equity is actually eroded by inflation. What's good having a mortgage is your debt is getting eroded by inflation. But if you're not even going to get an interest rate lower than inflation, than CPI, then where's your debt erosion? Where's the debt erosion happening right now? Maybe in the near future that inflation is going to be so much higher than the current rates But yeah, if they did drop rates, I'd probably consider buying a house, because technically, if your interest rate is a lot lower than CPI, than inflation. If you're getting a 2% interest rate and inflation becomes 4%, then technically that's free money that you're getting. You have a negative rates. So I might consider at that time, but I'll still consider everything, that you're gonna have house repairs. You know, you can't just call your landlord to fix this and that. So yeah, renting is that's the alternative. Why you shouldn't just buy a house. This coming from a realtor. Like I said, I'm not desperate for any commission. I want to educate people. I want to be able to help. So here is another great chart. It's coming from the Kabisi letter. So it's saying here, this is also the home prices adjusted for inflation. Case-Shiller, same as this chart from Federal Reserve's. Case-Shiller adjusted for inflation, right? So we have this Case-Shiller chart. So it's saying here that that during this 2008 bubble, right? It's basically four times the U.S. Census Bureau median income ratio, right? This is home prices with a median income ratio. So it's basically saying home prices is about 4 times the income here, and it has to come down to income, right? Like, home prices has to come down where people can afford it. Otherwise, there's gonna be no buying happening. You know, a little, but it's not. Your argument can't be because supply is low. You gotta consider both supply and demand. If you're like too bullish and in fantasy land that you just think real estate will go up and up and up and up, and you don't challenge your own biases, then you're just only gonna go with the supply. Supply is low. House price is never gonna come down, right? But in reality, there's another part of the equation, the demand. So you gotta consider supply and demand. What if demand goes down because all these jobs are getting lost because the 10-year treasury is saying we're gonna have a crazy, massive recession? Not me. That's not my opinion. It's the 10-year and 2-year treasury, and recently the Psalm rule, right? So right now, wouldn't you argue that we're definitely in a bubble out here in 2007, 2008, right? And right now, we're here, much bigger, much higher, much bigger, right? And it's 4.59 times ratio of the median income ratio, right? So I think we're just bound to grind down slowly back to the trend line. This is the trend line right there, like a trend line going there. So kind of back to here, right? I'm gonna grind down slowly back to the trend line. So that's what I think about house prices right now. Don't just get a real estate agent that's gonna bring the FOMO on you, the fear of missing out. Honestly, if you put that $700 in an asset like Treasury, that's gonna give you 5% for sure. That you already beaten, because you're saving like $700, $800 to rent, right? If you put that, then that you're making more than what equity you could have been making, you know. And then by the time that it's really a good time to buy a house, and you still have that liquid, if you put it on like a short-term treasury or like a dividend stocks that's like Aristocrat, that's mostly not affected by up and down of the market. There's dividend stocks out there that are dinosaurs that are here for centuries old. They're called aristocrats, and they're not just affected by they've survived recessions here and there. Although I did sell a bunch of them recently to prepare for this incoming recession, where I am leaning. You know, I'm not sure. I'm not 100%, but if you look at the yield curve, I say the probability is there. You could say that it's different this time, but if you say it's different this time, do you really want to put your bet on that probability on that side of the argument that it's different this time, when throughout history it's been happening the same thing in the cycle, right? So I'm leaning on the other one. I'm not saying I'm 100% correct. You know, there's things like the government can print $8 trillion all of a sudden, right, and stimulate everybody. But I'm leaning on the side of history. So yep. So if you need a realtor who's not gonna lie to you and is gonna tell you the charts, the government charts, historical charts, that would be me. I'm in Houston area. I'm gonna put my email on this. Also, please subscribe to the channel if you want to get informed with real data and it's not gonna bring you the FOMO, the fear of missing out, and it's just not gonna not just gonna like tell you to buy because I need commission. Then I'm your real estate agent here in Houston, Texas. If you need someone who's because I don't want I don't need one transaction from people. I'd rather have a real long-term friend, somebody I can sit down with at Texas Roadhouse and have a ribeye steak with and talk about the market. And while I'm not pushing you really to buy anything, we're just like really talking about facts. If you need a realtor who has who's gonna be honest to you through and through, and then I'm gonna leave a link on my email. A good friend, that would be me. Your real estate is probably the most expensive thing that you're gonna buy in your lifetime for most people. So get an agent who really know what's going on, who not only understand their local real estate market, but also understand what's going on in the macro economy standpoint and the Eurodollar system point of view. Because I know that real estate is a hyper local asset, right? It's hyper local, basically. What's happening to LA, it doesn't mean that it's the same prices that's happening to Houston, or it's the same. What's happening to Houston is not what's happening to Austin, So it's like a separate individual market almost. Like some markets are going up in value, like Houston. I'm not saying Houston's going up in value. I think Houston's inventory is increasing actually, but real estate is hyper local. But you'll get occasionally like the PPP loans and all the stimulus they did into 2020. Even if real estate has their own individual market in each cities that everything's different, there would be macro events that will affect pretty much everybody, like all the 2008. That I would argue that it's not just the mortgage-backed securities, but it's also a liquidity crisis in the Eurodollar system, because all these international banks in the Eurodollar system are just like interconnected ledgers. So if there's a liquidity crisis that's happening right now, like right now, I believe what's happening in Japan right now is related to what's happening in the stock market right now. So you need somebody who doesn't only understand the local market, but who also can give you a point of view, additional data that will support your conviction. In a macro level, right? So that's what you're getting from me. So subscribe to this channel if you're helping out. If I want to do a more local instead of like national media and stuff, and I want to do a more local video soon. And if you want to see that, please subscribe and hit that bell notification button. And we're gonna learn a lot more about real estate and macroeconomy in this channel. Let's go learn wealthy. If you're finding a lot of value in this video, please like this video and subscribe to Learn Wealthy and get notified.